Hey there, can you believe it? We had a massive bill passed in the Senate over the weekend, and we're going to talk about it today. Billions of dollars going to work in the US. Good thing, bad thing. We're going to get into that a little bit today. Welcome to SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. And I'm excited to have you. This week, overall, a somewhat light news week. But we've got a few data points to get into. We obviously had some groundbreaking information come out of the weekend with the inflation bill, the anti-inflation bill that passed the Senate by the skin of its teeth. So let's dive in. So starting out this week, let's go right into this bill. So this anti-inflation bill came out, and it passed the Senate with a vote of 51-50, with the Vice President Kamala Harris being the definitive or tie-breaking vote. Now, I'm not going to dive significantly into this. I don't want to get into politics, but what I do want to do is I want to point out a couple of key pieces of this bill that impact us as consumers and the economy. So the first thing that really stood out to me on this was a 15% minimum tax on corporations that are in excess of $1 billion a year. And so the importance of that is we're going to see corporate tax potentially go up. There's a lot of companies that through various reinvesting tax strategies have been able to dramatically reduce or eliminate a lot of their tax obligation. And so putting the 15% minimum tax on corporations of that magnitude, one, is going to generate a lot of revenue for the United States economy. But at the same time, it's also going to put a significant cost on some of the country's and world's biggest companies. And so what is that going to do to our economy? When company cost rises, a lot of times that gets felt and trickled down to the consumer in other ways. So that's one thing that we want to keep an eye on. The second item that stood out in this bill was there's a $2,000 annual cap on prescriptions for seniors. And this is a good thing. Obviously, prescription drugs can get very, very expensive, and depending on whether seniors are on Medicare or private insurance, but medicine in general can get really expensive. So having a cap could definitely be a beneficial aspect for seniors who are typically working with a fixed income in a lot of cases. The third thing that stuck out to me was a renewal of the electric vehicle tax rebate, the credit, extending it beyond the end of this year. Now, companies like Tesla, who have already exceeded their allocation for the tax credits, will now be able to partake in the tax credit extension again. However, there are some stipulations. So the credit itself is $7,500 for new vehicles. And in this bill, they've added $4,000 credit for used vehicles. The key, though, is the $7,500 new vehicle credit has a price cap of $55,000, which conveniently excludes Tesla's most popular model, which is the Model 3. So it's really designed and targeted at auto manufacturers that are producing low-cost electric vehicles. So something that we want to keep an eye on. And then lastly, another big impact to our markets is that this bill contains a 1% stock buyback tax for corporations. So when companies issue stock, and you've got institutions, you've got investors buying that stock, companies have the ability to buy back or repurchase their own stock. And that reduces the amount of shares that are in the marketplace and ultimately helps with the value of the company, the stock price. Well, the bill includes a 1% tax on buybacks. So should this bill pass the House of Representatives as well, we could see a lot of public companies rush to do stock buybacks before the end of this year, because these wouldn't take effect until next year. So again, more things that we want to keep an eye on, but we need to see if this is going to pass on the House. But pass the Senate, by a vote of 51-50, Kamala Harris being the deciding factor. All right, enough about politics. Let's get into the economy and how it affects us in the housing market. So last week's numbers, really important. We got the Board of Labor and Statistics National Jobs Report, and this was a surprise to the upside. The market analysts were expecting about 250,000 new jobs created for the month of July, and we actually got 528,000 new job creations. So blockbuster number, double what was expected, and the unemployment rate ticked down unexpectedly from 3.6% to 3.5%. Now, quick note on that. You have the Board of Labor and Statistics Jobs Report, which is job creations. And then you have a household survey that goes out, and that survey is where the unemployment rate is derived from. So sometimes those two can have a disconnect. In this particular instance, they were in lockstep with the higher jobs report and then unemployment ticking down, very much to surprise. Now, with GDP, gross domestic product, showing a slowdown in the economy, the question really needs to be, is this surprise jobs report to the upside just a lagging indicator as our economy continues to slow down, or are we still running full strength ahead as an economy? Really, only time will tell as we get additional data, but something that I think we should keep in the back of our mind. We also got our weekly jobless claims on Thursday of last week. And just as a reminder, for those who are watching for the first time, jobless claims are unemployment claims, and it's broken down between initial and continuing claims. Initial claims are individuals filing for unemployment for the first time. Continuing claims are individuals renewing their unemployment claims. So the initial claims, the previous reading, and these are week over week, was 254,000 new claims for that week. Last Thursday's reading was 260,000. And I'm going to talk more about this in a moment, but very important, the direction that we're seeing that trend. Continuing claims also ticked up from the previous reading of 1.368 million to 1.416. So we're kind of getting some contradictory information in the economic data. On one hand, we're seeing job creation and we're seeing unemployment tick down. On the other hand, we're seeing unemployment claims continue to rise, which is what we've seen for the past 3 to 6 months. So something's got to give. So watching both of these on an ongoing basis is going to be very telling on which direction that we're actually going with the economy. And ultimately, that's going to trickle down to our housing market. So our housing market can battle through a recession in a very resilient way. Going back to the 1960s, every recession that we've had in our country, with the exception of one, technically two, if you want to call it that, we saw house prices continue to rise, and we saw appreciation continue to rise, and the housing market stay strong. The exception to that was, of course, 2008, less of a cyclical recession and more of a crash, in my opinion. And then we did see a blip on the radar of home prices declining a hair back in, I believe it was 2000. But in general, every recession since 1960, we've seen home prices continue to rise. And so still a great time for home buyers to be in the marketplace, making those purchases, gaining the equity, building wealth. All right, so that's the jobless claims. Looking ahead to this week, again, pretty light news week, but we've got some pretty big data coming out Wednesday and Thursday. On Wednesday, we get an inflationary report, CPI, which is Consumer Price Index. This is inflation report at the consumer level, measured on a basket of goods. And then on Thursday, we get PPI, which is Producer Price Index. And this is inflation measured at the wholesale and or manufacturer level. So what we want to see, are these going to tick down? The market's expecting these numbers to come down from the recent highs. The market on CPI is expecting to see numbers in the high 8s, like 8.6, 8.7, down from our 9.6 levels. And this is really going to start to tell us whether the Fed rate hikes that we're seeing are having an impact. Ultimately, they will, but the question is how long is it going to take for that to impact? Couple of quick side notes, and I'm going to pull a chart up for you real quick as well, is we've been inverted with the 10 and 2-year treasury. And what that is, there's the yield spread. I'm going to share this with you real quick. Let me pull it up. And so one of the major economic recession indicators is the spread between the 2-year treasury and the 10-year treasury. Typically, the 10-year treasury is at a higher yield than the 2-year treasury. You would think as an investor, if you lock your money away up for a longer period of time, you're going to be rewarded with a higher return on investment. Well, that is typically the case, but here we have our spread between the 2 and the 10. The 2-year treasury note is currently, and has been for a while, you see over here in this, this red space right over here, we are currently inverted with our 2 and 10-year yield. And if we go look at actual yield levels on the treasuries, we can see that we've got the 10-year treasury sitting at loading. All right, so the 10-year treasury about to pull up. And we'll take a look at the 2-year as well. Let's try refreshing this one more time, see if I can get this to come up. All right, loading the charts. So when we have a yield inversion, and the 210 is not the only yield curve that we're looking at, but it is one of the primary focuses and one of the major indicators of recession. So we've got the 10-year treasury sitting at 2.79 right here. And if we take a look at more treasuries, my systems are loving me today. There we go. We've got the 2-year treasury sitting at 3.28. So as of right now today, you have a better return on locking your money away for only 2 years versus 10 years. And that's very abnormal. It's not typically the case. So whenever that happens, every single time that this has happened in the course of our economic history, we have ended up in a recession. So when you hear the media, you hear the government talking about no recession, we're going to avoid a recession. Yes, is it technically possible? It is. Anything can happen. However, is it likely that we will not end up in a recession? And my personal opinion is that the answer is no. I feel that we are heading to recession. And the better question is, will it be a very deep recession or will it be a very shallow recession? And those answers are yet to be determined. We're going to have to live through it and figure it out. But watching things like the weekly jobless claims to see what trend that we're seeing, very important. We've seen jobless claims go from under 200,000 in a week to now upwards of 260,000 in a week. And there are more reports coming out weekly and monthly of companies looking to reduce staff, lay off employees. And so we're seeing the country slowly move in that direction. Now, this is not all doom and gloom. Again, lots of positives in the housing market. The housing market typically stays strong during recession, as you've already heard me say. But what's even more important for you, if you're a real estate agent, if you're one of our clients or a potential client watching right now, what's really important is to look at what you can do to recession-proof yourself. And some quick hits that I've talked about before is 1, focus on building savings, continue to sock away as much as you can. 2 is reduce expenses. Take a look at that budget and see where you can trim to make room for more savings. Because if you've got 3, 6, 9, 12 months of savings in the bank or of income in the bank, a recession is not going to have a massive impact on you. You're going to feel much better about it. So that is what I'm going to leave you with today. I want to say thank you to all of you. If you're watching on the Powerhouse YouTube channel, thanks so much for joining. Make sure to hit the subscribe button below so that way you can get all of your real estate information straight in the palm of your hand on your phone. If you're watching in the Powerhouse Real Estate Facebook group, thank you so much for being an amazing member of our real estate community. If there's any questions that you have, reach out. My number is right here below, and you can always leave comments down below the post as well. Have an incredible rest of your day and your week. Thanks again for joining me, and SRT Live.